So I'm in the process of writing my second book. My first book, Wealth Without Wall Street. And I'm writing my second book right now, and it's called Your Home is Not an Asset.
Yeah.
And what I've discovered in my research and also 26 years in the business is the average Canadian retires with about $260,000 of investments.
Yeah.
That's it.
Yeah.
So most people, they retire house rich, cash poor.
Yes.
This product has typically been known as a last resort product.
You know who made it.
Welcome back to another edition of the Wealth Easy show, where we talk all things wealth, health, and real estate. Today, folks, we're going to be talking reverse mortgages. And my guest today is Andrew Cairns, who is a 30-year veteran in the wealth industry, and he is now working for Chip Reverse Mortgage. Welcome to the show, Andrew.
Hey, John. Thanks. It's great to be here.
Yeah, thanks. Give us a two-minute bio on yourself and how you got involved in the wealth industry, and now you're in, doing Chip Reverse Mortgages.
Yeah, it's an excellent, transitionary story. I'd been in the wealth business for about 25 years, and very, very familiar with the world of portfolio management, investment funds, insurance strategies. And one day I was approached by a very close friend who lives in Kleinburg, and said something to the effect that they're working for HomeEquity Bank, other words, the Chip Reverse Mortgage. And they said, you should have a look at it. And I said, there's absolutely no way I would consider working for a reverse mortgage company. And then I over time, I was approached, and then learned rather quickly that the reverse mortgages that I thought I had in my mind at the time as a financial professional were not, in fact, what reverse mortgages were. And then through that process was introduced, all the way up to the president of HomeEquity Bank. And lo and behold, I saw that this is a very, very significant untapped marketplace, and made the conversion to become a banker, and spend most of my time now with financial professionals and their clients talking about where the reverse mortgage might fit.
In the traditional financial world, and I came from that world, I was 17 years as a Bay Street advisor,
Yep.
and I left that world in 2016, the traditional advisor role. Most advisors kind of frown upon like a reverse mortgage, because their whole gig is, give us all your money on an ongoing basis, do it as often as possible, and let us build this asset so that when you get to retirement, you have this portfolio. Being in the wealth industry for so long as you have, what is your take, and how do you approach mostly reverse mortgages are for people like starting around 55 and plus. How do you approach people with a reverse mortgage?
Yeah, absolutely. It is an interesting iteration or change in dynamics that's going on. The more that the financial professionals are being informed about it, the more they're starting to understand exactly where the reverse mortgage fits. And agreeably, it doesn't fit every circumstance. But if we can find and tailor it to the right client and structure it the right way, it makes not only total sense, it actually advantages that client. So, the attitude that financial professionals has changed is dynamic. Acknowledge those that maybe have not researched it yet might similarly, be at a stage where I was at one point. But now they're essentially looking into the facts and the structures, and things are definitely changing. And my perspective with, financial advisors collecting money in order to invest to maximize long-term wealth is great. But the practical side of the business ignores the fact that people have to live. People have to enjoy perhaps their retirement. They have to spend time traveling, inviting grandchildren down to see them if they live, in a warm community or whatnot. So there's this, real circumstance right now where life is getting more expensive, and cash flow becomes a little bit more critical than just overall net worth.
So I'm in the process of writing my second book. My first book, Wealth Without Wall Street. And I'm writing my second book right now, and it's called Your Home is Not an Asset.
Yeah.
And what I've discovered in my research and also 26 years in the business is the average Canadian retires with about $260,000 of investments.
Yeah.
That's it.
Yeah.
So most people, they retire house rich, cash poor.
Yes.
This product has typically been known as a last resort product. Talk to us a little bit more how it's generally now today, it's not really a last resort product. We're going to get into, that retiree who is now entered in retirement and maybe is in the position of house rich, cash poor. How do we access it? But it's not just the last resort product anymore. And I know you've got some stories of some people that don't even need the money and how they get to access the equity in their home, because most people think their home is the greatest asset. It's not. Your home is only an asset, and correct me if I'm wrong, is if and when you can access the equity in that.
Yeah.
Right?
Yeah.
And if you've lost your job,
Yeah.
you don't qualify.
Yeah.
Talk to me about COVID and how many people, their businesses were shut down.
Yeah.
And how many people were laid off and they needed money from someplace. And they didn't qualify, even though they had a ton of equity. They didn't qualify because the bank looks at it and says, hey, you need to have some income, and without that income, you don't qualify. But this is a different product.
Yes.
Explain to us how the chip reverse mortgage works and why it's not even deemed as a last resort product anymore.
Yeah, yeah. Congratulations on the new book coming out.
Thank you.
That's really exciting.
Thank you.
And it really actually jives into a number of issues here. When I first got involved in the investment community, over 30 years ago, the house was never really anticipated to be the investment that we all know next time you get a knock on the door from a real estate agent trying to tell you how much your house is worth. It was frankly a place to raise your kids and look at it as pure housing or a pure housing option. It just by the nature of markets in most major Canadian cities has, quite by surprise, ended up being the major store of value or wealth. And obviously the biggest problem is how do you access that wealth, right? You can't sell the living room, right? You can't sell off the guest house in the back of it. Some of these rather fancy places I get to see. So really the only way to access money or capital from a house that you want to continue to own is to use a loan product. And loans have been around forever. The go-to solution that we're all familiar with is the home equity line of credit offered by the major 5 banks. Been around. Great idea.
But you got to qualify.
Yeah, got to qualify.
And you need income.
Exactly. So that in reality, and again, it just isn't until you have your boots on the ground to actually see the stories that happen. Is right at the exact same time. Well, let's go back. Do you remember when we were all taught this whole thing of you have your high income, your high notice of assessment, your high T4. Waltz into your local bank branch and qualify for the largest line of credit you possibly can, so that could be like an emergency reserve, right? That's the way I was taught financial planning back 30
Even
years
if you
ago.
don't need it.
Even if you don't need it, go
Qualify.
apply. Okay, so that was a sound strategy. But what a lot of people don't realize is about whether it be a mortgage or most likely a home equity line of credit is you must be required to be continuously qualified for it. In other words, how is your job going? Show us the T4, and at the exact same time that better generation Canadians, they're saying, no, I've entered retirement. I'm retired. I have pension income, and then the banks very quickly are saying, well, maybe we better scale back that line of credit. So at exactly the same time that you need to maybe release some of this equity from the house, it becomes increasingly difficult to qualify for it. Your point on.
Hey everyone, it's John. I just wanted to thank you for being here, and I would ask that you please subscribe to the show by just clicking the subscribe button right here. I'd really appreciate it. It helps grow the show so we can get even more successful guests on the program to help you. If you're already subscribed, a huge thank you. When you subscribe, you're going to get access to the program before anybody else does. So if you would, just click subscribe right here. Thanks so much, and welcome back to the Wealth Easy Show. Yeah. So, what is let's get into the nitty gritty of what a reverse mortgage is, because there's a lot of people, they may have heard the term, they just don't know how it works, and they may think, you know, I want to leave my home as part of my legacy or inheritance for my kids, and if I do a reverse mortgage, the bank takes my home.
Right.
I no longer have my home.
Hear that story all the time.
Yeah, I can't leave it for my kids.
Right.
Or I can't sell it. I have to move. There's a lot of myths out there and a lot of misinformation. So why don't we get into, so that the audience isn't confused of what a reverse mortgage is? Let's break it down and give us the basics.
Yeah, sure. So first and foremost, it isn't a mystery. It's actually quite simple. And in fact, what it is it is a mortgage targeted to an older demographic of Canadians. So, our audience members that are listening and are younger, it's not that you need to know about this too, because it's likely perhaps your parents or your grandparents that would want to be, having a quick look at this. So, and also because it's, the whole family is often involved in these decisions, it's really, really wise that everybody open their ears to these issues. So the reverse mortgage, what it is legally exactly like an existing conventional mortgage that you would get from a typical bank. Where it differs, however, is that the way it's qualified for and essentially the terms and conditions that do not require a monthly payment. So
let's repeat that again.
Yeah.
It does not require a monthly payment.
That's right. And there's a trade-off for that.
So there's no cash flow issues.
There's no cash flow, and that's really what it is. If I could summarize, where we'll end up concluding, is a reverse mortgage is a cash flow solution for most families. So the reverse mortgage, essentially, if it acts and smells like a conventional mortgage, but it has a different way to qualify for it, what are those qualifications and what are the compromises? That's a really good question. Well, the first compromise for those that are used to going in to talk to conventional banks is they can usually lend at very, very high ratios. 60, 70% of the total cost of a home could likely be financed. And in return, a conventional bank is looking for consistency of that family to be able to maintain monthly payments on that loan. For a client that is past 55, but more likely in their 60s and 70s, that would be the typical client, they've gotten to a point where they may have some sort of existing debt. That's fine too. But they've effectively paid it down, let's say, or have no debt at all. And in order to convert and receive cash from their home, they need to take out a loan. But what they don't want to trouble themselves with is the monthly payment associated with a home equity line of credit or mortgage. So where a reverse mortgage steps in is we trade off the income questions for two or perhaps three major questions that affect us and the nature of our business. And that is, how old are you? So this very sounds much like how a life insurance contract might act. How old are you? And how much is your house worth and where is it located? So on one hand, if we know the age of a client and the value of their home through an appraisal, plus location, some markets are more dear than others, then we can essentially provide a loan that does not require a monthly payment. Effectively, the cost or interest is deferred, or the proper word is accrued, to some unknown point in the distant future. The biggest issue is to make it very clear to anybody listening, is the reverse mortgage bank, CHIP Reverse Mortgage, Home Equity Bank, does not own your house at any time. The home ownership, and that's a good thing because that house keeps going up in value, that is retained by the owner. We effectively are just simply a loan against the title of that home. So what do you got? You got a mortgage that is similar to what you might think a regular mortgage might be, but it has no payment. Next, it was qualified based on somebody's age and the value of the house, as opposed to how much money they bring in and have to declare to the government.
Why is age important?
Well, if we could, frankly, a 82-year-old has a certain lifespan that they're likely to stay in their home. And you may think that we're anticipating that a client might pass away and then at which time a reverse mortgage has to be repaid. So when the owner of the house leaves the home, then that is the signal to which the reverse mortgage bank, CHIP Reverse Mortgage Home Equity Bank, has to be repaid. So an 82-year-old has a more certain lifetime left in the home.
A mortality table is probably
Exactly like
probably-
insurance.
Yeah. So actuaries look at it and says, okay, right now, if you're probably going to leave your life expectancy based on the actuaries are going to be 87. So so now the older you are, probably the more money he has access to.
Exactly.
So the younger you are, if you're 55,
you have a long future potentially in front
so
of you.
now you're probably going to do what, like 50% loan to value if the guy's 55 versus an 82-year-old. I mean, you might access and give him more.
Yeah, it's not quite like that.
Because the interest does accrue, there has to be a cap.
Yeah, right. Because we would never want to see the loan
Offside.
balance be more than the house is worth.
Right.
So you're exactly right. The seesaw in this equation is the younger you are, and you're at 55, you might qualify for 24 to 20, perhaps 7% of the value of the home. It marches up. So, for example, a 72-year-old, they might qualify potentially 42, a little bit more percentage value of the home. That's our average age of recline. 82, we get into the zone of 55% of the value of the home. And it's really, really significant because in the spirit of sort of like everything's known up front, the approved amount doesn't change. So when somebody locks in and they, get 40-odd% of the value home or 55% of the value, we can't take that right away from them. So they have confidence knowing that they can move forward. So, really, this is also a great way to identify who a reverse mortgage is not for. It typically is generally not directed towards a younger Canadian that perhaps has a lot of debt because we can't effectively pay out the debt that they already have. So the sweet spot for us seems to be around age 72 for most Canadians. And then, of course, as age marches upwards, we can lend more. There is one very important thing to unpack, though, is the matrimonial home. Regardless of who's on title of a house, if a couple is married, the surviving spouse they retain ownership of the home. So therefore, when a reverse mortgage goes into effect, unlike typical credit solutions, it's mandatory that we consider the age of both spouses. So, I've run into circumstances in putting this in place where there's very, very large age gaps between spouses. So, for example, if a 77-year-old is married to somebody that's 53, we can't even contemplate the reverse mortgage because that surviving spouse is only 53.
So you're going to base it on the youngest spouse.
It is biased by the youngest spouse. There's different
Because you're not going to kick them out of the home.
We can't.
Yeah.
We can't. So naturally, when a reverse mortgage goes into place, we have to qualify both spouses. And here's a big lesson, and this happened to me personally within my family, is it's different than most bank credit mortgages and home equity lines of credit. They're qualified, let's say husband and wife, for example, and both spouses have to essentially pony up with their income information. If one spouse were to pass away, it happened to my sister sadly recently, her husband at age 44 passed. And they, I was a part of a meeting at a conventional bank. I walked in, and the first thing you discover is that home equity line of credit that was supposed to be there forever and ever, right? All of a sudden it's inaccessible because one half of that mortgage line of credit facility is no longer there, and nor is their income. So essentially, it's a freeze in all credit.
Did they have life insurance?
They did, but as you know, sometimes it's a bit of a challenge. Specifically when you're facing down a $35,000 bill for a funeral service, that sometimes that insurance isn't paid real quick by some insurers. So those are things that you have to factor in. The way we work with the CHIP reverse mortgage is we qualify both spouses. So there's essentially an automatic transfer of the rights to the reverse mortgage. The money, in other words, passes to the surviving spouse. So, these are those really interesting life lessons that you learn by practically doing my work that people don't anticipate. They don't realize that credit isn't forever. And most certainly with conventional credit, it's only as good as somebody can show up with their income, right? And a lot of people discover that upon the renewal of mortgages, which is happening right now.
So one of the big things that I promote when setting up a whole life insurance policy and overfunding it is that when you get to retirement, if you've followed my advice and you've been diligent in making your premium payments on time, you've overfunded, you get to retirement, you've got this cash value that you can actually leverage with the third party lender and you receive tax-free income. And it's very similar to
Exactly.
the home equity lender,
Yeah.
so the chip reverse is that you don't have to make monthly payments on that line because it accrues and it all gets paid
That's right.
when you die.
Yep.
Now, a lot of people like that because it's tax-free income because you can't tax debt and it doesn't affect or impact your government OAS. Now, a lot of people might think, well, does that same rule applies with a reverse
Right.
mortgage?
Oh, it's an excellent
How
question.
is
Yeah.
that income?
Yeah.
Because it's not really income; it's a loan,
That's
right?
right. Yeah.
So explain how it's not taxable and won't affect
First
benefits.
of all, John, you're getting me very excited because this happens to be my expertise. So I most of the work that I'm assigned by my bank to work on is I'm going to call it the more sophisticated or higher net worth client. But this equally applies to anybody, any of your audience, because there's some really tax smart stuff. Exactly as you had said. A reverse mortgage works very, very much like a loan on an insurance policy. It's just in this case, we're using the house.
home as a collateral.
Exactly.
Yeah.
Exactly. So, and it also doesn't mean you have to take all of the money that you qualify for. Like let's face facts here. If we're in, Toronto and we're looking at an average price of a decent detached home, 1.3 plus, right? And you've got an average client 72. We're talking people that qualify for a $500,000 chip reverse mortgage. It's a lot of money. And not all of our clients need that money. So when you have a reverse mortgage, the only necessity is to take out enough to surrender any existing debt you have. But the remainder that you can choose to use it.
Is it a line of credit?
It is. It is. It's like it's not exactly a line of credit, but it sort of acts like a super line of credit because you don't ever have to requalify for it again, right? You can access it any time on an ad hoc. You just make a telephone call. If you only used $100,000 and you qualified for $500,000, you could call for an advance of $50,000 all the way up to $400,000. You mentioned a really cool case. I think is, and I've been involved with this in recent days here. Is if somebody is not max funding an insurance policy, maybe some of that cash that is available through a reverse mortgage, it could be used to max fund and overall benefit the estate. It's just an idea, but most certainly don't ever lapse a policy. That like always pay your premium. That's one big lesson that we've all learned. But is the opportunity to enhance the wealth not just for the retiree, but the entire family is also at play here. We're just simply using the house as a tool, really, at the end of the day.
So let's say you qualify for $500,000.
Yep.
So it's not really a $500,000 line of credit where you can just go in and make withdrawals. Do they do like advances? So they'll take, say I need $100,000. They'll just deposit $100,000 into your
That's
account.
right. It works exactly like that. It works exactly like that. So there's where the similarity to a home equity line of credit is. The difference between a reverse mortgage and a home equity line of credit is not the accessibility to money that you qualify for. The difference is there may be conditions on bulk repayments of the amount. So if I take out $100,000 today to buy a car, let's say an expensive car, right? On the other hand, and then essentially $100,000 were to come back, it's a little bit more challenging to repay the $100,000 tomorrow. In other words, when you do that. So what we always encourage, because it is a mortgage, is to really plan what your cash flow needs are. But absolutely, so if somebody has room that they have qualified for, first and foremost, the interest that might have accumulated on the reverse mortgage does not affect that access to that predetermined credit amount. So if it's $100,000 they need, they just simply make a telephone call or an email to us on typically 48 hours notice. We essentially have it deposited to their checking account. So, as an example, and I know you like stories.
And that money, by the way, just so my listeners are very clear on this, that money is non-taxable.
Absolutely. So
it's debt.
It's debt. So, that is the secret sauce a little bit here is that Naturally, your listeners that have registered RRSPs or RIFs, for example, the further you dig into your RIF for cash in order to pay for stuff, there's an anticipation that you're going to have to pay a withholding tax. And as your RIF gets larger, you're wealthier, you're in a higher tax bracket, then this dreaded OAS clawback comes into play. So, I've been quite involved with, affluent families. And I don't think it has to be an affluent family. It can just be a tax smart family to say, let's not take too much money out of my RIF. You have a minimum to take out, but let's not take too much more than that. Let's actually go and use a little bit of the living room money via reverse mortgage, a tax-free advance, so they don't have to pay the tax too early on the RIF. So, there's a lot of strategies at play, and every family is different, but, it is definitely the tax smart strategies using reverse mortgage. That's sort of like that's my sandbox.
Yeah. So I know you got some really cool stories. Let's talk about someone who may be in a high net worth situation.
Yeah.
I mean, I met with a client yesterday, and sitting down and going through their financials, they've got 1.6 million in RRSPs. Like, do you realize how you're going to get murdered on tax?
Yeah.
He's got a defined benefit pension.
Yeah.
And the moment he starts attacking that RSP or the RIF, like, he can delay it, but he's going to get nailed heavily on tax.
Yeah.
If they've got a home, for $3 million,
Yep.
65, they can wait till 72 and then maybe just have to take out the minimum and maybe do a reverse mortgage. Not that they need the money because they out there, but they just don't want to get hit with the tax.
Exactly. So and it's interesting. I worked in the area of pioneering these maneuvers, if you may, and the first clients that I onboarded were actually the parents of financial advisors. They were doing that because they had figured it out. They had run all the numbers on the particular family, and there's a couple. The tax is going to be owed one way or another down the road. The further you can kick that soccer ball down the road, right, the better. And there are certain other strategies for certain families, meltdowns and whatnot. But the point is the tax will have to be paid, and the more you can defer, the better. Here's the bigger issue, and this is facing many families in the GTA, is multiple generations are looking at each other and they're going, what does mom and dad have? And what do I have? And there's a disparity there, right? Mom and dad have the old home. It's the place where people continue to gather. Thanksgiving's coming up. We know that there's going to be a big party there. And the children are living in smaller homes, condominiums, and these sort of things. If there's any aspiration for that next generation to one day own mom and dad's home, I know it might be full of wallpaper and shag park, but I don't know. But if there's any aspiration to own a proper backyard and it does not make sense for mom and dad to downsize. And universally, and it didn't take COVID to tell us this, 93% of people want to age in place. But it fits a second bill is it keeps the property in the family. That could be the house maybe that the next generation grew up in, could be the family cottage, these sort of things. These assets for the many parts are tax efficient. The growth on the principal residence is also tax-free. So what sense does it make to shed that house too early and essentially find an alternative and not have the tax-free gain on the principal residence going? So, countless stories, and I don't want to jumble them too many times, but what we're learning from this is today's reverse mortgage consumer is aspirational. They're thinking smart. They're thinking tax savings. They're thinking, how do I preserve it for my family? How can I best benefit the entire family?
But it also relieves a lot of stress too, because if you've got someone, retirees who are 70, 72 years old, and maybe they bought the home, in the 1970s and they paid $150,000 for it, and today it's worth $1.5 million.
Yeah.
And they raised their kids in this, and they have so many memories, and now they get to a point where
much stuff,
right? Hoarders, right?
Yeah,
they've hoarded stuff. Like my grandfather, he had a double car garage, and I think one of the happiest days was, wasn't happy to my grandmother. My grandfather passed, But she's like, I can finally get rid of the shit that he's been collecting for 50 years in this fucking garage. You couldn't open the door and get in there. So she was happy to say, call, got junk and come and just get rid of this shit.
Yeah.
But it gets to a point where you're 72 and you're looking at your finances and going, we cannot survive on $1,000 or the
OAS, CPP,
OAS and CPP that this government gives us.
Yeah.
We need to sell this home, and we're going to pay 5% real estate fees. We're going to pay transaction fees. We've got moving costs. We've got to pack everything up. The stress about that, and now instead of having to go through that, you say, hey, we can remain in our home. We don't have to move. We don't have to pay all these transactional costs and the stress of moving and buying something that is probably been overpriced and relocating someplace else. They get to stay in their home and retire. And like you said, live out their last remaining years there, and their family gets to continue these memories. So now let's get to they've passed.
Yeah.
Now what happens to the home if the kids want it?
Yeah, a really important factor, and we can jump into all sorts of great stories. The most recent one that I had was exactly you talking about the packing up the stuff. What about the husband? This happened to me recently. The husband, he's no longer with us. There's a little bit of a cash flow issue in terms of maintaining the house, but there's a train set in the basement that covers the whole thing. How do you pack that one up for a widow in their 80s, right? That is something you don't want to do in a hurry, right? So you pointed it is the primary solution that a reverse mortgage solves is a cash flow solution, and then from an emotional standpoint, reducing the stress. Those are the two most important factors that I see. So the big question becomes is when does all this money have to be repaid? So remember, the reverse mortgage, the amount borrowed plus the interest, is only paid at the time at which the last spouse leaves the home. The ownership of the home stays with the spouse, the last spouse, and when they pass, the home passes, and this is super important, it passes to the estate. The HomeEquity Bank, the CHIP reverse mortgage, does not own the client's house. It passes to their estate. But it does signal the time to get the work done and the notice out to the family to say, hey, what is your plan in order
There's an outstanding debt.
There's an outstanding debt, like any other mortgage.
Yeah.
So if somebody passed away with a conventional mortgage, it's the exact same issue. So the point is when somebody passes, first and foremost, there is no immediate payment due that day type of thing. Estates take time to work out, right? So what we want to get confidence on as a bank is who is the executor? Do they have a plan? What is their plan? If I were to say it was in Toronto, more often than not, the plan is one of the kids wants to move in the house. And in that case, we say, great. In order for us to essentially remove the reverse mortgage from the title and pass it along to the new sibling owner, they have to pay us out. So we get paid out and life goes on. On the other hand, many people want to sell their house and they need a little bit of time to prepare it, to remove the train set, in other words, from the basement. We're completely flexible to be able to do that and allow a reasonable amount of time to happen in order for us to receive the repayment of the loan that we have. Frankly, for our circumstance, we're a Schedule I Canadian bank. HomeEquity Bank is owned by the Ontario Teachers Pension Plan. We've been around just shy of 40 years. We have to deal with these circumstances all the time. We want to make sure that each one of the families that we have on board is treated, with courtesy, respect, that they refer other family members, and more often than not, the next generation take out the reverse mortgage. We've been around that long, so it's in our best interest to make sure that everybody's treated well.
So at what point do you say to the family, hey, this debt's outstanding.
Yeah,
you got to sell the home.
Yeah, well, naturally, if it comes to that, we'll have that I'm going to call it a courageous conversation with the family. But consider the case with anybody that's dealing with mom or dad's home and they've passed. Normally, the family is dealing with this anyway, whether there's debt or not, and what is the next step? The house just doesn't sit there, right? So it's in everybody's vested interest because the estate is the owner of the home. They don't want that home to deteriorate. They want to make sure that there's a plan. If somebody in the family is going to move into the plan, tell us what the plan is. We'll organize our approach there. But, indeed, a lot of people just, they sell the home, but they want to sell it properly. And then, of course, you're familiar, John, the issue of probate, is taking longer and longer and longer. That's okay. We're used to this conversation. So as long as we have confidence that the estate has a plan, that they've taken this a serious approach to, the next step of what they're going to do with mom or dad's old home, we're comfortable.
I think the easiest way to settle that discussion is with proper planning that the parents had life insurance.
Exactly.
With the carrier's going to pay this thing out within 15 to 30 days, usually 30 days max. They pay out it. Boom. Money arrives.
I wish I got an insurance policy from you.
Money arrives. Boom.
Yeah.
Pay it off. Now you can take whatever time you need to figure out what you want to do with this home.
Exactly.
Right? The life insurance will settle this problem right away.
Look at it this way too, John. Imagine that it's just a conventional mortgage, right? And that were to happen. Well, the bank doesn't say to the estate, stop making your payments. Not only do they want the home, essentially a plan for the home to be sold or some transfer or repayment of the debt with a conventional mortgage, they also want the monthly payment. That is not a factor with a reverse mortgage. So maybe the better way to look at it is the reverse mortgage, provides breathing room not only to the original owners of the home, but to the people that are executor that is settling the estate.
I've talked to people about a reverse mortgage. People ask me questions about it. And you know what their misconception was? The interest rate is like loan sharking.
Yeah. Yeah.
I'm like, where did you get this information from?
Yeah.
Like, it's not. Talk about because it's very competitive.
Sure,
it's pretty competitive.
It is very competitive.
Very
It's
competitive.
very competitive. And in Canada, there's more and more people entering the reverse mortgage business. So HomeEquity Bank, CHIP reverse mortgages, roughly about 80% of the reverse mortgage new business onboarded. So we're the dominant player here. But where I hear that story often mentioned, and I hear it less and less, fortunately, is there's a lot of drift northbound from the United States in terms of understanding of reverse mortgage. And there is fundamental differences between Canadian and U.S. reverse mortgages. Reverse mortgages in Canada, Schedule 1 Canadian bank, there's a lot of stuff on the line in terms of reputation and accessibility. The other thing is to understand that unlike HomeEquity Bank that offers only reverse mortgages, the major 5 banks do not offer reverse mortgages. So there's been a symbiotic relationship.
Yeah, I want you to say, because that's really important. You just can't walk into RBC or CIBC and go, I want a reverse mortgage, because it's a very specialty product.
It is.
And there's only a few players.
That's right. But the fortunate position that HomeEquity Bank is in is we are the go-to source for the major banks to refer business directly to us. So one way or another, we typically see the majority of reverse mortgage business in Canada, one way or another. It's a great position to be in. But in the United States, reverse mortgages are typically insured. And therefore, because of the insurance cost on it, the rates tend to be a lot higher than Canadian rates. Like I can put it into perspective. As we're talking right now, it would not be untypical to find a reverse mortgage from HomeEquity Bank at 6.69%. This is less than 1% difference to home equity line of credit rates. So it makes it a viable alternative, but it's not even an apples to oranges comparison, or it is an apples to oranges comparison, because the reverse mortgage, of course, might have a higher implied rate, but it's not paid every year. It's deferred or accrued into the future. A conventional debt is we're going to require time in, time out, month in, month out, a cash flow to be able to do that. So if somebody has like a vacation on their mind, right, chances are is they got to first calculate their monthly expenses and then factor in the debt payment that they'll have to make on a home equity line of credit. A reverse mortgage actually takes that stress away a little bit. It allows you to reallocate things. And my specialty is a little bit beyond the family vacation. It becomes into this tax planning strategy, working in cooperation with tax professionals, investment advisors, these sort of things, in order to put together a package that makes financial sense over the long term. I'll go back to the one thing that I said though, is the biggest issue, and sadly you're not going to find too many brochures on this, is if mom and dad shed real estate or downsize too early, they're giving up a lot of gains. Like if you look at a house, like this morning I was, in a home easily worth about $3 million. And if we were to arbitrarily say that the, rate of inflation is 2%, and then we say the real estate market's not doing 1%, it's likely a 1% increase. Imagine that. Just by the act of mom or dad staying in that house, there's a $30,000 gain in the equity value, tax-free, just by the act of staying in the house. So
on average, I think over the last 40 years, home prices have increased 4 to 5%.
That's right.
And I would say on a very conservative scale, 4%.
So for me, it doesn't even take any projection beyond 1% to help show how a reverse mortgage makes sense. If somebody's borrowing a couple $100,000 and accruing, or essentially taking on the cost of the reverse mortgage, but interest costs, but not paying it, a couple $100,000, that puts us in the range of, I don't know, $14,000 worth of accrued interest each year, approximately, right? So if somebody owns a house worth $3 million and it's growing by 1% because I'm overly conservative, that's a $30,000 gain. That means that family, just by the act of staying in the house, is growing their net worth, right? So a lot of what we're talking about here is essentially reorganizing things in order to give maximum benefit and maximum cash flow flexibility. And, then all of a sudden the wheels start turning, people get used to it, and they go, I've got another great idea. I still have access to that $1 million that I was approved for, and I only took out $100,000. The residual $900,000, is there other stuff that I can do with my insurance professional, my tax advisors or whatnot, in order to maximize my family's overall wealth, right? And you brought up the example of insurance strategies, right? And that's really where, not to overly use the term the rich get richer, it is just simply to give a family cash flow flexibility to do these things or these maneuvers. I'm just the lender. It's very powerful.
Without breaking confidentiality, can you share some examples? And I know you shared one with me when we were at a conference last week of how wealthy families are getting creative using a chip reverse mortgage. You told me a story about an elderly lady. That's a great story.
And John, these are the greatest ones because you really get to know the clients. And my tendency is to deal with aspirational, fun clients that have dreams that they want to accomplish. And in the circumstance we were talking about, there's a lady in her 80s that has a particular hobby that is quite unusual. Is that she is essentially the queen mom, if you may, of car shows in her area. And she showed me and took me down to the parking garage to show a beautiful late model Corvette. And I was trying to figure out why, with this home that's worth just shy of $2 million, and I know about another $1.6 million that are in stock. And we're talking like stock that's been around since 1971. So if she were to sell it, the stock, there'd be like monstrous capital gains to do that. And, I had to ask the question, why am I here? Why am I talking to you?
Because she's got assets. She's
got her assets. She's got great assassets and
like liquid assets.
Liquid assets and fast assets, because she's got this beautiful car. And in the circumstance, she turned to me, she says, well, I want the 2025 sports car because I want to make an impression at these car shows. It's her hobby. It's her hobby. It's her passion, right? She has no children. She's been widowed for 23 years, and it's her passion. She wants to do it. So, the point is some of the audience will say, well, why not cash out some of those investments? Well, she gets dividend income from those stocks. If she were to cash it out, she loses the dividend income, but more likely is going to have to pay way more in the capital gains tax that is owing. She has pension income, if I recall, $90,000 in some place. And, she could say to herself, I'm going to pack away $20,000 a year and save up for my $140,000 car. That's an alternative. But the alternative has bad results because she's going to be, on the lighter side of 90 years of age before she can afford to buy her dream car. So the reverse mortgage or taking a loan against the property on a tax-free basis was the most logical way to her to aspire to her dream. And listen,
And she's got no kids, so
Yeah.
you're not thinking, oh, let me leave because she lived as a home or
it was a
condo.
condominium, and interesting. It had
In Forest Hill.
yeah, and it had a balcony the same size as the condominium. It was unbelievable.
So she's not concerned about, my children need this. She's like, no, let me access my equity today
yeah,
in a tax advantaged environment.
yeah, and not cause myself tax problems.
Yeah.
And whatnot, and then live my best life and have the fun that I deserve to have at her age. And there's not an income problem. There's not a wealth problem. There's no problem whatsoever. There's a dream, right?
Yeah.
And this is more and more what I'm running into. And one of my most fascinating stories, and it goes back, and I have to go and share with you that the client has now passed away. But if I can rewind the clock 5 years on this story, and this might resonate with some of your listeners, is you're talking about people that grew up in their house, and I just said shag carpet and wallpaper, okay? And I know exactly how that feels. I know what orange carpet looks like because I've seen it all the time. And I have lots of cat hair in my lap to prove that I visit clients' homes. But, here's the truth, is some of this real estate is irreplaceable. It's in the most gorgeous locations, in your community, right? And the deal is that these homes are 30, 40, 50 years old, and they have the decor associated with a 30, 40, 50-year-old home. And the one thing that's lacking, though, is the limited amount of pension income coming in order to take on even a moderate renovation or redecoration of the home. And, real estate buyers today are so unimaginative. They want to walk into the home that's got the perfect granite countertop, the perfect color scheme, we're going to take out the Unistone driveway and put in patio pavers, all these things that are just surface value. They have nothing to do with the quality of the home itself or the location of the property. So, families are getting wise to this, and they're saying, hey, what if we actually put a preemptive mini or tune-up renovation to this home and put in the granite countertops, take out the shag carpet, remove the wallpaper, put that first ground floor bathroom in, and the renovation budget, and the one I'm thinking of was about $300,000. And that means they didn't have to spend $300,000 all at one time. They could do it on a paced basis. And then the client that I'm thinking of was 89 years old, and she was very excited about this because the children, she wanted to maximize the estate for the children. Mm-hmm. But she realized that she, at least in today's real estate value, an appraised value of $1.7 million, by the way, it was suboptimal to her neighbors that has the gussied up place down the street, but it's the same fundamental shell. Mm-hmm. So, what her anticipation was is she finally gets the granite countertop, but she gets the chance to spend $300,000 to maximize the value when the home is eventually sold, when she's no longer there, when the children inherit it, in other words. Well, they ended up spending only $200,000 on a very paced, conservative basis. And about 4 years later, I got the sad news that the lady had passed. But she got her granite countertop, and I had to say, they had told me that they had sold the house. Remember, even with a reverse mortgage, you can sell the house. It's your option.
Yeah, it's just that you guys get paid, right? Because there's a charge on it.
That's right. Just like any other
collateral charge.
Exactly.
And you guys are first to get paid.
Yeah. So you recall, the home was appraised at $1.7 million, sold for $2.5 million. So $200,000 into the house, plus real estate appreciation and whatnot, essentially maximizes the estate for the next generation. Like, that's a success story. And people, people are still thinking about a reverse mortgage, in a completely different context. I get to live it and breathe it every day.
Well, there's the reverse mortgage for the desperate.
Yeah.
Where
it exists.
Oh, absolutely. I mean, if you take a look at the demographics in Canada and the savings rate of people today, I just think, and I discussed this in my upcoming book, Your Home Not Being an Asset. Banks are giving some really bad advice to people and saying, hey, pay off that mortgage real fast, make extra payments, put more money into this home. Well, people might been convinced and saying, yeah, I'm going to save lots of interest. What people don't understand is, number one, interest is front loaded on a mortgage. If you take a look at amortization schedule,
You're advantaging the bank, essentially.
you're making the bank safer.
Right.
But the other problem with that is they are under no obligation to give that money back to you when you need it. So you're making extra mortgage payments thinking that you're creating all this equity, which doesn't earn you a penny. You're putting it into four walls, which earns you nothing.
Yeah.
You're making the bank safer, and you cannot access the equity if you lose your job,
Maybe your spouse pass away.
due to illness. Maybe the largest reason for foreclosures in Canada and the United States is due to job loss.
Yeah.
As a result of what? Illness or injury.
Well, look at my prime market. My marketplace is dealing with retirees. They don't have jobs, right? So effectively what we've done is we've taken the credit formula that conventional banks use is like, show us your job, show us your income, and we've traded it for what is your age and what is the value of the house. So effectively the tools by which we do our work are different than conventional lending. It's not better. There's certain aspects of it that aren't better. I can't lend to the same ratios if somebody has a lot of debt. But, and I have to deal with a certain demographic of retirees and whatnot typically. And the point is, the reverse mortgage is not the right solution for some families, but for other families that meet a particular demographic, particular home living style, have been relatively responsible with debt levels, they're a perfect candidate for a reverse mortgage.
Well, the person I think the perfect candidate for reverse mortgages is that person who did take the bank advice and were making extra payments into the mortgage because now they get to retire house rich and cash poor because they didn't actually put money over into building a liquid portfolio that gives them access, control, and use of. Where I'd say in my book, I'm going to say, hey, do not make an extra mortgage payment. Pay the minimum amount. Build a portfolio that gives you liquidity, access, control, use.
And diversification.
Build because when you put it into a home, like what did I say? Homes on average go up about 4% a year. Well, 4% of $1 million home, okay, that's great. That's $40,000 a year. But how do you access it? If you got injured or you're sick or you lose your job, you cannot access it. You have to do one of two things. You either have to sell the home and now you're forced again to find something else. Or if you can qualify, you can access it through a home equity. Now you're asking the bank permission again to get at that. And what do you need to qualify? Good credit, proof of income. Your debt servicing ratios need to be in line. Now, with a home equity line with the CHIP reverse mortgage, do they need good credit?
We do a credit bureau, and the only reason is, and it should be mentioned, what are the responsibilities of a reverse mortgage? I've already said, like we've already talked about, there's no monthly payment. So what are my responsibilities? I have to pay my property tax and insurance. And for very important reasons, like the municipality actually has a superior claim to your home than even a mortgage on your home. So property tax and insurance is really important. So the extent of a credit check is like, we have to have access. Like somebody may have, a gazillion dollars of debt outside of their home, in non-registered or judgments and CRA arrears and all this kind of stuff. So we naturally, have to have a good holistic picture of what's going on. But in fact, interestingly, even though other things might be going on, it doesn't change that family's qualification level. It just may determine the way they get it. I'll give an example. If somebody qualifies for $500,000 and has terrible credit and some debts outside there and whatnot, in order for us to feel comfortable with approving it, we may pack away $100,000 of their $500,000 and disperse it to them frequently, every 6 months, in order to make sure that there's always cash in the bank to pay their property tax and
Or
insurance.
maybe would you make it a condition to pay off some of this
We could.
outstanding debt to maybe free up some of that cash flow
Well,
for
of
them?
course, like like if somebody's sitting on a credit card, with $80,000 worth of debt, I've seen
At
it.
20%.
At 20%, then taking a reverse mortgage, 6.59, 6.69, I should say,
no-brainer.
and paying that off. Everybody wants to do that. So it's not so much putting a condition on it. It's just like totally makes common sense for most families, right?
Well, a lot of retirees too, they're going into retirement and they do have credit card debt. They do have other liabilities.
Oh, yeah.
And then this would actually free
I
up
can
some of their
quantify
cash
it.
flow.
I can quantify it. So the average client that applies for a reverse mortgage, typically has a house of around 1.1 million. This is Canada-wide, right? $1.1 million. They're about 72 years of age on average, and they usually come to the table with about $230-ish thousand worth of existing debt. Okay, it's not necessarily bad, John. It's not necessarily bad. There's usually good reasons for that debt. I'll give you an example. Is when we ask the question, how did you remember? This might be a family that paid $120,000 for the house in the 80s or 70s, and how now the debt, their existing debt is higher than that. How did that happen? Well, this broaches a whole new topic, right? But what we generally discover is that mom and dad went into their line of credit to do something for their kids, put them through school, give a down payment to the son or daughter in order to get them their first condominium,
Replace the car.
start a business, bail somebody out of a divorce. Lots of reasons.
Oh, yeah.
Right? So what happens is mom and dad's existing debt is usually not a sign of any degree of irresponsibility with debt at all. It's usually the facts of life and satisfying this multi-generational, wealth equation. So, normally the reverse mortgage, frankly, is a reorganization of some degree of an existing debt in most circumstances. Very, very rare do we find somebody that has no debt on their house, free and clear. That is not a necessity for a reverse mortgage. So the first step that a lot of people do into reverse mortgage land is effectively a degree of reorganizing existing outstanding credit. This is a good thing, right? You trade it for debt that has a monthly obligation that's causing stress to something that gives breathing room in order to plan. The interesting thing that's happening right now is with all these mortgages coming up for renewal and the payments doubling, is the majority of our work right now is we're approached by the family saying, can I make a payment on my reverse mortgage? And the answer is yes. Typically, we didn't see that in the past, but now increasingly families are saying, I was paying $2,000 a month for my existing debt. I can afford that, but I can't afford the new payment of $3,850. Can I pay $2,000 a month, my old payment, towards this reverse mortgage as I reorganize things? Absolutely, no problem. Yeah. So this is why the reverse mortgage is becoming more appealing to most families.
So let's talk about one thing with high net worth clients, high net worth families. How can a CHIP reverse mortgage fit in with sophisticated tax planning strategies for a high net worth family?
Right. And you likely hate the I'm not an accountant, so I'm not an accountant.
This is not accounting advice.
Not accounting 101 and whatnot. And every client's tax circumstances are different. But now we're going to open up the box to the high net worth client.
And this is something that these people can approach their accountant with.
Of course.
Right.
Of course.
These ideas.
Yeah, and there's even more possibilities for that affluent client, and one of them is we do have a significant number of clients that use CHIP reverse mortgage proceeds to make quality investments. So in tax law, given I'm not an accountant, there is generally Canadians have the right to be able to deduct interest costs for investments that are made into income-producing investments. That could be a rental property, that could be a stock that pays a dividend, for example, right? So,
if it has an expectation of a capital gain.
Well,
does that qualify?
Well, again, and not with my accounting expertise at all.
Interest producing.
It has to have the likelihood to produce income. Okay. Pure capital gains would generally not be. It could produce a capital gain, but the specification of the investment should produce.
So let's say a dividend paying stock.
Great. So therefore, if the client were to do that, and in cooperation with their tax professionals, they should have the right to be able to deduct the interest costs on any loan. There's a special rule with respect to reverse mortgages. Well, there's a special rule in the Tax Act that allows for deductibility of interest on what is known as an accrual basis, not cruel basis, accrual basis, versus interest deductibility on a cash basis. Most of the investing community that has outstanding loans that have monthly payments are used to deducting interest on a cash basis. A reverse mortgage, by definition, has the possibility to produce a pure accrual of interest. And therefore, an affluent client that uses it to invest would likely, with their tax professional, arrange for deductibility on an accrual basis. So what do you got? You got an investment loan that's going into a quality investment. It has a cost, but the interest cost of that is deductible. Probably that client's in a high tax bracket. That means that their cost of interest that they're deducting every year is relatively low, but they never had to come to the table and make a monthly payment.
Right.
So you can very quickly understand, for an affluent client that is oriented towards making investments in income-producing property and rental properties, for example, or anything like that, potentially even lending it to their own business, the reverse mortgage becomes super desirable. And this is sort of the sandbox that I help work with financial professionals, tax people, in order to arrange these sort of things. And to give you an idea of the magnitude of loans, is like we're seeing some of the largest reverse mortgages done in Canada. And it's very, very exciting, very, very satisfied clients. I'll introduce you also to another concept that is in that high net worth space, and that's the concept of blanketing properties. Okay, so in a reverse mortgage, these are all things that you're very rarely going to find in a brochure. You'd want to have a conversation with a person like myself would be like the good starting point. But a reverse mortgage is tied to a person's principal residence. And the reason it's a principal residence is because we have to have a measured life of who lives in the property. That determines ultimately when the reverse mortgage is paid off. But then we can begin to what we call blanket in multiple properties. So, for example, I've come across circumstances in the city of Toronto where there's a person that has a purposely crafted low income with their tax professionals. I'm thinking of one that had $65,000 a year's worth of income, yet owns $11 million worth of real estate on the same street in Toronto. They own the street, effectively. Well, that client would typically have a struggle to go into a conventional bank and with their $65,000 income and qualify for a loan for $1.5 million to buy the 11th or 12th house on the same street.
Right.
So a reverse mortgage is an ideal circumstance here, because as long as we have their anchor principal residence tied up, we can essentially blanket in an additional property, maybe even an additional property. They have to be homes. They have to be like residences. But effectively now we have a pool of capital that we're measuring our reverse mortgage contract about, and we can give that client the check or deposit in their account to make an outright cash purchase on their home. So this is the more sophisticated side of reverse mortgages that many of the audience won't know about, because they're sort of thinking about the reverse mortgage that you may have heard bad things about. But increasingly what we're discovering is a more and more affluent market is being benefited by these tools as opposed to what you might think a reverse mortgage is.
That's a really great strategy, actually.
Yeah.
Yeah. So, we're about running out of time, but for our audience who's listening, we might have piqued their interest in a reverse mortgage, at what point should someone start considering it, and who can they talk to? Like, who is able to sell a reverse mortgage or assist someone in getting that done?
Yeah, it's a great question. So the word sale is not particularly associated with reverse mortgages. So we are a Schedule I Canadian bank. So under typical circumstances, an employee of HomeEquity Bank will end up doing business with the client. And it's a technology, that has to be essentially, taken care of by an expert. So what we have typically done in Canada is set up referral arrangements so that a qualified financial advisor, a lawyer, an accountant can refer business to the knowledgeable source at HomeEquity Bank in order to get the job done for the client. In other words, the responsibility for setting up the reverse mortgage falls with HomeEquity Bank, and we work with referral partners. Of course, clients are invited to call us directly. That's a natural, of course, as well. But what I would suggest is, as always, is speak with a qualified financial professional, and in order to get that advice and get referred to the right source that has the information in order to get the reverse mortgage done. One additional fact that is important is a reverse mortgage is not something that's done in a hurry. It takes time in order to put it in place. Typically a month and a half is a usual runway for a reverse mortgage to get done. So there's lots of time to consider all the issues. But one additional thing is that the final paperwork is always signed in the presence of the client's own lawyer. In other words, independent legal advice beyond the bank, beyond the financial planner, beyond the accountant. There's a lawyer that reviews all the paperwork at the final stage before a reverse mortgage goes into effect.
Can someone contact their mortgage broker to do this?
Yes, absolutely. They can contact a reverse mortgage broker that has been set up with, for example, HomeEquity Bank, and effectively get the similar service.
Have you ever been in a situation where you've actually advised someone not to proceed with a chip reverse mortgage?
All the time. So
What would that look like?
Yeah, so I'm going to suggest to you that most of the clients that I would suggest not be involved in a reverse mortgage tend to be not yet, meaning we're generally approached with a really, really good circumstance, but because they're relatively young age, that it's not time yet. And effectively, time has to percolate in order to put that family in a better position. So that might be paying down a little bit more debt for a while, and then approaching the reverse mortgage. That tends to be the typical one because we can't lend a younger retiree, 55, if you may, as much money as obviously somebody that's in the prime of retirement. So, today, for example, might be typical for me to be talking to people that I spoke with 3-4 years ago that have been playing the wait and see game. Obviously, if there's a client that has so much debt, I came across a circumstance with somebody that literally had 80% loan to value on existing debt. That client's likely never going to be a reverse mortgage client because they've gotten themselves into a place in life that they've just taken on too much debt, and they likely would be more benefited by, selling their house. The other circumstance that I would say is if somebody is in really, really poor health and you anticipate them moving into long-term care home care is not a possibility. That'd be a non-starter for me in order to do a reverse mortgage. That, on the other hand, we have a number of clients that do receive home care, $60,000, $80,000, $90,000 a year, and there's been a pledge and a plan to keep them in the home. Reverse mortgage could be really good. But if they're the last one, there's nobody there to take care of them, they're ill, and they're likely benefited by an outside facility, likely not the best idea to maybe go with a reverse mortgage.
So I think the earliest age you can really actually, it makes sense, is starting at what, 55?
55 for both spouses. So if somebody's 55 and they're married to somebody that's 50, we can't even contemplate an application. So that would be something, if there's a small amount of debt outstanding, great. We can likely take care of it. If it's less than a quarter of the value of their house, it's definitely an option. And remember, it's a lot of people think of the reverse mortgage as permanent. It's really only as permanent as you want. You can sell your house, you can pay it off, new technology here. You can port your reverse mortgage. So we have lots of people that are moving from one house to another, and they take their reverse mortgage along with them. Oh. It's not quite as easy as that. There's some work involved in doing that. But during the COVID cycle, we had a lot of reverse mortgages that started, for example, in the GTA, but the reverse mortgage has now been ported to a permanent Four Seasons cottage, or what used to be the cottage that is now the primary home, in Muskoka, for example. And that's something that, we're working with, a person like myself that, have seen, well, actually, I hope to see more things that I've never seen before, because there's a solution likely for many things.
Amazing. For people who are listening, what's the first step?
Yeah, my first step, again, it would be to contact their financial professional and, share that you've learned a little bit more about a reverse mortgage, get their opinion on it as well and whatnot. Naturally, if you want to reach out directly, we're always available. We have resources to get in touch with people like myself. But my first step always is, because as a banker, I don't see the full scale of everything. I don't see the insurance that you have in place. I don't see the financial thing. It's not my vocation. My vocation is to serve financial professionals and put a good reverse mortgage plan in effect, in combination, in harmony with what already they have.
It's just going to enhance what they're doing. And you work with the financial professional, right?
Every day.
Yeah. So if anyone is interested, they can just Google CHIP reverse mortgage and they'll find HomeEquity Bank, right?
They'll find us, and one piece of advice is that the reverse mortgage, the CHIP reverse mortgage, is accessible in many different ways and whatnot. But I would say the first call is to the financial advisor, and of course they can Google me, and I'll set you in the right direction if they need to.
Great. Andrew, this has been real great. Thank you for joining us today. Guys, if you like this episode, please subscribe to the channel and share this with your friend. And don't forget to like and follow me on other platforms. That's all for today. Take care of your health and your wealth.